Ladies and gents, traders and investors, a very warm welcome to our channel Polo Vega. On today's video presentation, we shall be exploring the possibility of using option strategies to participate in day trading or get into trades that can be closed within a day or at the most by the opening bell of the next day or the following trading day. We can use all kinds of option strategies, but we must be very careful about the parameters which we've been discussing about while trading options. The first one being the volume of the underlying being traded, or the volume of the options that we want to get into. The second one being the liquidity. The third one being the time decay. The fourth one is the market trend and the trend of the asset or the underlying on which we are going to place an option trade. Then we must look at the news events like the earnings or any economic news or any other announcement that could affect our trade, because volatility change on a day trade can make or break your trade. And lastly, we must look at controlling the risk by placing stop losses at a price that we think that we would like to get out if the trade doesn't go in our direction. But before we move on to discussing option strategies for day trading, we shall also be visiting the regular charts that we've been seeing every week. Number one, the US dollar index or the DXY. Number two, S&P 500 based ETF, which is ES. Number three, NQ or the Nasdaq based ETF. Number four, Nifty or the NSE 100 based ETX. Number five, XAU/USD, the gold based ETF. Number six, XAG/USD, the silver based ETF. And lastly, the US oil spot, which has been going up and down in big leaps every single week, either up or down. Disclaimer/disclosure. The contents of the presentation are for information purposes only. The material has been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the 53rd of a series of interactive videos aimed at educating our viewers, and we'd like to warn all our viewers of the risk associated with the business of trading and investment. Securities trading and investment is a highly risky business, and there exists a possibility of partial/total loss of investment. The ideas and opinions in our video are solely based on our analysis of the market, and we do not advise, recommend, guide anyone to take any trades based on the contents of this video. We do not take any responsibility for partial/total losses arising out of trades based on the contents of the video. The chart on our screen is of DXY, the US dollar index, and we're looking at the daily chart. DXY has now managed to clear the sell orders in the supply zone between 101.077 and 101.887 and has formed a double top before its reversal and closure at about 99.789, and it's currently trying to take out the buy orders at about 99.27, below which there is another intermediate zone at 98.622, and finally there is a nice strong demand area at about 97.48, and therefore we would expect it to find some reversal at this area if it doesn't manage to reverse out of the earlier two zones specified at 99.27 and 98.56. So there is a chance that it could get a bounce of these areas, but it could then not be able to clear out the support area about 100.39 or slightly below that, because that was the area which was trying to stop its downward movement, and now we could find a lot of sell orders left behind in this area, and would act as a supply before it could attempt to move further up. The chart on our screen is that of ES, the S&P 500 based ETF, and we're looking at the daily chart. ES has managed to print an explosive candle on Thursday, which recovered all its losses from the previous week, and then on Friday it printed another bullish candle to close at 7519.25. The demand zone between 7272.6 and 7314 has proven to be very strong and has given a bounce for 3 consecutive sessions. Now the current price is located between the supply and demand zone, and the immediate overhead supply lies between 7587.35 and 7688, which was the all-time high of the index, and we still expect to find a lot of sell orders left behind before the index consumes all the sell orders and tries to break out or turn around under the influence of excessive sell orders left behind. The chart on our screen is that of NQ, the Nasdaq based ETF, and we're looking at the daily chart. Unlike the S&P 500, NQ has been weaker and has already established a downtrend by breaking out of the demand zone between 27995 and 28501, and finally closing right at the top of the demand zone between 26833 and 27150. It had a bounce from this area and is currently struggling to take out the sell orders left behind in the demand turned supply zone between 27995 and 28501. So the demand zone now has turned into a supply and is trying to obstruct the upward movement of the index, and we could see a fall from this location, or it could go further into the overhead supply between 29152 and 29658. So 29658 and 29131 is the immediate supply that could bring the index back in its downward direction. With established downtrend, we now can look at shorting the index at any opportunity on the daily chart or on the 240-minute chart or on the hourly chart. But shorting is the trend or the trade that one should take, and shouldn't try to go into longs until we see a strong reversal from this particular zone that it has bounced off, which is the 26833 and 27150. The chart on our screen is that of Nifty, which is the Indian National Stock Exchange Index, and we're looking at the daily chart. Nifty is making its 5th attempt at clearing the resistance area at 24619, which could still have some sell orders left behind, but most of the orders must have gotten depleted, and we could expect a breakout of this area on the next attempt of Nifty reaching at 24607. Therefore, it's best that we either look at taking a breakout trade with a tight stop loss, or wait for Nifty to print its next candle after it has hit the resistance area of 24600. If it bounces back, then we have the same support area which has been supporting it for the last 1 month, and that's the area at 23800. It has acted as a very strong support, and we could expect the Nifty to trade sideways within this zone with a chance of breaking out towards the top, which will be above 24600. There is a law of strength. I has printed a continuous range of green candles during last 1 week, and if the momentum continues, we could expect a breakout next week. The chart on our screen is that of XAU/USD, which is the gold based ETF, and we're looking at the daily chart. After scaling to its all-time high in the month of January 2026 and then reversing most of its losses in two trading sessions all the way back to 4391 from 5610, gold made its way back to 5411, and then on it has been bearish and very weak, establishing lower highs after lower highs each week, and then it has gone into a consolidation phase since the beginning of this month. However, one can see that gold has not been able to gather much of strength in spite of the weakness shown by the US dollar this week. In spite of the US dollar printing two consecutive bearish candles, gold has stayed between 4025 and 4120. It has been consolidating within this range of 100 from 4120 to 4020. One needs to see if the consolidation continues beyond this point where it could break out, say by the end of next week or week after next, or whether it continues to trade sideways without breaking down below 3942, which was its lowest low of this year, or whether it tries to break above 4161, which has been holding the asset class for a very long time. If it manages to break above and close above this particular line of 4167 or 4170, we then know that gold is trying to gather some strength to restart its uptrend. The chart on our screen is of XAG/USD, the silver based ETF, and we're looking at the daily chart. Silver has been very weak for the past couple of weeks, and in the last 1 week it has just printed dojis after dojis, but it hasn't shown much of weakness or strength in either direction. So one needs to wait and see as to the breaking out of this particular asset class below the 53.5 zone, or whether it breaks above 60.75 and finally above 63.86 to start the beginning of a new uptrend. But as of now, we can see that it is going sideways, and there is a chance that it could break below 53.5 to find a new demand zone or a support at about 45.23, which is the low from December or October last year. The chart on our screen is that of US oil spot, and we're looking at the daily chart. US oil spot has continued with its downtrend and has taken out some more of its gains to close at 68.7 after hitting the low of 67.11. One needs to see if it can manage to take out the demand between 63 and 66.5 and break down further to come all the way down to 55, which was the low from December last year. Otherwise, one can expect oil to continue moving sideways for a while until the situation at the Strait of Hormuz is absolutely clear and until the negotiating parties have come to an agreement about the movement of vessels through the Strait of Hormuz. We shall now continue talking about the option strategies that we could use for a day trade. First of all, before we move on to talk about the option strategies, let's first look at the ability to carry out a technical analysis of the charts of the asset or the underlying on which we would like to place our option trade. We must be able to locate the entry and exit points, which could be the support and resistance areas and the beginning or the end of a trend on a previous trading session or on an earlier occasion. So basically, we always look left to establish an opposing area and to establish the point of entry as compared to the position of the current price. We must also be able to use indicators like moving averages, RSI, MACD to know the direction of trend, to see the momentum of the trend, and also to be able to establish the point at which the current price is trying to reverse its direction. So the establishment of the entry, exit and direction must be ahead of our decision to get into or to select an option that we would like to buy or sell. Now we select the option that we would like to get into, which could be the buying or of a simple call or put option, or we could buy a vertical spread like by getting long on a call option and then going short on an OTM call option, or getting long on a put option and then going short on an OTM put option. We could also trade a straddle in case we're looking at a price swing, and we could use an iron condor to collect premium in case of a low volatility condition. As indicated earlier, we must be absolutely sure of the high volume of the option trade that we're getting into and the liquidity or the open interest shown on the option chain, because if the open interest is high, then the option is quite liquid and we could get a very small spread between the bid and ask prices. Also, it will be easy for us to get in and get out of the trade. And lastly, we must play it safe by putting a stop loss at a position that we would like to get out depending upon our risk appetite. And most important of all, we must have a predetermined target which has to be at least 2 to 3 times the amount of risk that we're ready to take to get into the trade. Once we've ascertained the underlying asset on which we're going to place our option trade for it to open and close during the same day, or rather most by the opening session of the next day, we then decide to choose the option that we're going to get into. In case we think or we expect the underlying to go up during the day, then we buy a call. In case we expect the price of the underlying to go down during the day, then we buy a put, and we must be backed by an inflation in the implied volatility during the day. So that would help us reach our target as soon as possible, or at least during the day. In case the implied volatility is expected to be low during the day, then we choose to go for a covered call where we sell a call and we are already long on the underlying. This would help us collect a premium and allow the call option to expire worthless after it has reached the expiry date. And otherwise, if we expect a sudden explosion in the implied volatility during the day, then we choose to go for a straddle where we could look at making money from the price swing in either direction. And the last one that we could do for a day trade would be an iron condor, where we expect the implied volatility to be staying low and we collect a premium on selling both call as well as put options with long OTMs to protect our position and limit our losses. A simple trade would be to go on a call or put on an index-based ETF, as most of the indexes, they have their ETFs traded heavily, so the volume and liquidity is not a question, and there is enough of open interest so that the bid and ask spread is absolutely low. So this could be an SPY on the S&P 500, a QQQ on the Nasdaq, or a Nifty on the NSE 100. The SPY and the QQQ have got options expiring almost every day, so we could get into a buy trade on a put or a call expiring the next day, so that if we are unable to close it for the day, we could close it by the opening of the next day. If we choose to trade one of these index-based ETF options, then we've got 5 stages in which we can divide our day, and the most important part is that we should not overtrade during any particular session. Even if we've made losses, we should stop trading and wait for the next opportunity on the next day. Day trading is extremely risky with options, equities, or any asset class, as we are heavily dependent upon the direction of the trend and our analysis of the direction, if it falls right or not. So if we go wrong in our analysis of the direction, then we are going to get into a loss, and the only smart move then is to cut our losses to the minimum. So if we decide to trade the SPY, the SPY, QQQ, or the Nifty, then the first stage is the timing of the trade. We open our charts, the 3 time frames that we discussed right in the beginning of our video presentations, where we chose the biggest frame to be the one that where we determine the curve. Then we look at the intermediate chart time frame, where we are looking at the trend, and then we look at the lowest time frame, the LTF, where we place our trade. So it could be a 1 minute chart or a 5 minute chart that we could put our trade on, and then we could have the 1 hour trading chart as the intermediate time frame, and the 4 hour chart as the chart that determines our curve, means the beginning and the end of the trend on the left side of the current price on our chart. The current price is always preceded by the pivots on both the up and the down sides, and those are the areas that determine the end of the trend that we want to get into. So our target has to be within these curves. It's a very important decision, and also we must notice that in case of options, these areas will have the highest number of open interest with the maximum number of open positions lying there. So that would determine our resistance or our support on the lower side. Once we've chosen the time frame, like we said, we should not enter the trade in the first 1 hour, so that we allow the underlying to find its direction for the day, and based on the direction established in the first hour, we then go ahead and choose our trade. That's the second stage. We choose either to buy a call or to buy a put, and if we expect the implied volatility to be low, then we sell a covered call. In the worst case, if the implied volatility is low and we do not have a long on the underlying, then we can look at going into a vertical spread where we sell the strike price closer to the current price, and then we buy an OTM further away from the current price. In this case, we expect to retain the net premium that we have been credited at the beginning of the trade. We then immediately put a stop loss on our trade as soon as we've entered, so that we know that if the trade is going against us, we get protected by the stop loss limit and we get out of the trade at the soonest. And finally, we choose our target or the point where we want to close the trade. In case we cannot close the trade during the day and the trade is still moving in our expected direction, then we let it remain until the opening of the next session, where we close the trade irrespective of what the direction of the day is. So this is how we trade simple calls, puts, covered calls or vertical spreads depending upon the implied volatility. And once again, we will say that for a day trade, the time decay is very important. It has to be, the expiry date has to be closest to the trade, but not for the particular day on which we are trading. So the expiry date could be either the next day or anywhere during the week, or at the most a week later. So that's how we trade simple calls, puts, covered calls in a day trade to make some fast money during the day, but with all precautions as outlined during our video presentation today. We now come to the close of our video presentation for the day. We hope that our discussion on different kinds of option strategies for day trading were informative and exciting enough for you to try at least the simple strategies where we buy calls or we buy puts depending upon the direction of the underlying, and then we put a stop loss to limit our losses and a target to close the trade at the soonest possible time. But we do not allow the trade to run beyond the opening session of the following day. We shall be looking at other trades where we would analyze the situation vis-a-vis the implied volatility and the complex strategies that can be used during a day to take advantage of the news coming out on a particular day, or the lack of news with a very low volatility for the day. If you've liked our video, please hit the bell icon and subscribe to our channel Polo Vega. You may also visit us at our website www.polovega.com or get in touch with us for our Twitter handle at Polo Vega. We thank you for watching our video and wish you all the very best. Please like, share and subscribe to our channel Polo Vega.